let me speak about some of the major developments that are happening with DLF. It is still into very early stages of its journey, and therefore I feel that it is one of the best real estate sector stocks, so to say. Hi everyone, welcome to today's video. So on today's video, I'm going to speak about 4 real estate sector stocks. Now the question would be that, okay, why are you speaking about real estate? Why not technology sector? Why not some other sector? The reason there is very simple, and here is a chart to prove it. That over the last 1 decade, real estates have been giving really bad returns. Now, of course, when a sector is highly depressed, but there is underlying value in that sector, there is always chances that it will start re-emerging. So I feel that right now we are at a cusp of this sector getting revamped. So therefore, real estate becomes a good investment sector from that particular perspective. Second key point, that real estate has gone through a lot of turmoil in the last 10 years. Now, here is a study that was done by RBI, and it categorically said that 2008 type of real estate crisis is not happening in the economy. And there is something called a CRAR ratio, which is well above 9%. So which means that the lenders who have lent out money in the real estate sector, they are net above regulatory requirement. So in simple word, it means that despite depression in the real estate prices, still the real estate sector is very much resilient and the lenders in that space are very much resilient. Now comes the third and the most important part, that this sector is bouncing back. It is estimated that starting 2023, this sector will start booming a lot. So from that particular perspective, it might not be a bad idea to at least understand what are some of the good options and bad options in this sector and what is the investment thesis that you need to have. Also, a big shout out to our sponsors for today, which is Vested. It is a US stock investing platform. So in case you're looking to buy some stocks in the US, you can definitely check out Vested. Also, they are running a competition of creating your own vest. In case you perform well in that competition, you stand to win cash prizes. So check the links in the description box. I have linked out all the information. So let us get the discussion started, and 4 stocks that I'm going to speak about. 1 is a US stock and 3 are Indian stocks. So let us speak about one of my favorite stocks from the real estate or realty sector, which is Airbnb. So what does Airbnb do and what is the business model like? It has a fairly simple, easy to understand business model, that it is connecting short-term renters, people who want to rent properties on short-term basis, and the house owners whose properties are lying vacant. So this model is amping up, and it used to do extremely well before the pandemic broke out, and now it has started to come back up again. Now, what is the major moat of the business of Airbnb? It is trust, as per my understanding. What do I mean by that? So in very simple terms, if you compare Airbnb with, let's say, something like Ola or Uber, what is the primary business model of both these parties? It is that they are aggregator platforms. But in Airbnb's case, the platform needs to generate a lot more trust. Think about it this way, that if you are renting a property in Goa, then wherever you are renting that place, you need to be sure that, okay, you know what, wherever I'm going, that needs to be safe, secure place. I will not be thugged. I will not be tricked. On the flip side, the homeowner who is renting out the property, they might think that, okay, I really hope that the person who is renting this place from me, they do not damage my property. So the platform, which is Airbnb, it needs to generate a lot of trust. And this was the major problem or the major proof of concept that Airbnb had to generate. And they had been able to generate that proof of concept quite profitably. Now, if you check the price of Airbnb, it is somewhat available at a discount as per my understanding, and you can clearly check it from the charts. So if you check, Airbnb peaked out at roughly $212 and now it is trading at somewhat 50% discount. But are the results so bad? That's a simple question that you need to ask. And for this, you can check the last 6 quarter results for Airbnb. And every single quarter, Airbnb has beaten the expectations of analysts. Now, here is a chart to prove it, and you can clearly see what analysts expected and what results Airbnb ended up giving. So overall, everyone was betting on Airbnb to fall or generate bad results. And analysts so far have been wrong about Airbnb. It is a solid business with a very clear moat. Now, let me show you a few key charts and graphs and prove it with data where Airbnb model currently stands. So first and foremost, Airbnb is clearly expanding. Now, what do I mean by that? I simply mean that right now, Airbnb is focused on making money through 3 different verticals. One is that when they rent out a particular place, they charge a little bit of kickback from people who are renting the place and from homeowners as well. This is very logical that they are making two-way commissions here. The next key vertical in terms of growth are the experiences. Now, think about it this way, that for example, if you're in Goa or if you're in Manali or if you go to Hong Kong, then there are communities which would do like morning walks. There would be communities that will do like cycling rides. There will be community who will do like cooking classes. So these are called as experiences, and you can book these experiences through Airbnb. So going forward, it is estimated that their experience vertical is going to generate a lot of money for Airbnb. Now, what is helping Airbnb business are some of the macro changes. One of the key macro change that is happening is the work from home economy. And a lot of companies are now allowing their employees to go and work from different locations. So therefore, these tourist-based spots are seeing more longer and frequent bookings, and Airbnb business is picking up because of the rise of gig economy, so to say. And this gig economy is fundamentally going up. So here are some numbers to prove it. So you can clearly see that in 2018, there were approximately 204 million people participating in the gig economy, and right now, or approximately in 2023, this number will more than double to 455 million. So this is a big rise in the gig economy work culture, and they will be signing on more long-term rentals, and Airbnb business definitely picks up. Of course, there can be counter arguments that, you know what, that I will just simply go and bypass Airbnb and try to find places on my own. Yes, you can definitely do it, and some people will do it. But again, please go back to the first factor that I was talking about, that Airbnb actually generates trust. So as a platform, it is a required platform, so to say, to mitigate a lot of risk, both for renters and leasers of that property. Now, all this talk that I have been giving, can I back it up with some numbers? So let me start showing you some charts. So this is the revenue overview, and please compare quarter-wise performance for a business like Airbnb, because the short-term stay market changes significantly as per the seasons. When people have more holidays, when their kids are off school, then of course they are going to take more vacations, and something like Airbnb's revenues will pick up. So therefore, doing quarter-wise analysis for a business like Airbnb makes a lot more sense. So coming back to this, so if you take a look at quarter one numbers for 2019, you will see that it was standing at roughly 800 million. Then 2020, it went down a little bit. 2021, again back to the same levels. And 2022, Q1, there has been increased growth. Now, similarly, if you take a look at Q4 performance, so we have 3 data points here. So again, you can clearly see that there has been a very clear increase in the Q4 performance of Airbnb's business, that there has been a very clear rise. So generally speaking, the revenues for Airbnb has been going up because the travel industry seems to be back. Now, that is not the only positive point. Even the gross booking value or the ticket size booked, every booking, that has been going up on an average. Let us look at quarter one performance here. So again, you will see that it was approximately $10 here. Now in 2021, again around $10. In 2022, you can clearly see that there has been quite a significant jump here in terms of the total booking value per booking on an average. So as a result of these positive developments, the net balance sheet of Airbnb has been quite healthy, and this can be clearly seen in terms of the net cash that Airbnb currently holds, that it is going up, which gives more fodder, more power to a business like Airbnb to create more product lines and further go about consolidating its profit. Now, is it a push from my end for you to go and buy Airbnb? Absolutely not. But I will quickly recap that number one, the business is already doing, it is beating analyst expectation. The balance sheet seems very healthy. The business is coming back, and right now the stock is trading at quite a significant discount. Not a recommendation to buy and sell. Please understand from my tone and draw your own inferences. Now let us move on to stock number 2, which is DLF. It is one of the prominent real estate companies in India, and there are a lot of changes that are happening with DLF. Now, first and foremost, DLF has been one of the oldest real estate developers in India. They have literally built Gurgaon. I was trying to find out the data that what percentage of Gurgaon they have actually built. I could not find the data, unfortunately. So let me know in the comment box in case you know of that figure. But I would say that they have played a major role in terms of developing entire Gurgaon. Now, Gurgaon market is getting saturated, and as a result, one of the key things that has happened with DLF's business is that unfortunately, their rate of growth has slowed down quite considerably, at least for the last 15 years. So let me quickly take you through some financials, and then I will talk about the updated business model of DLF. So you can clearly see that the market cap of DLF is fairly big. It is not a very small company. Also, additionally and interestingly, the debt to equity or the amount of debt that DLF has is not too big as of now, especially for a real estate company. These are very manageable levels of debt. Now comes the most interesting part, which is the amount of sales that they have been generating for the last several years. So if you check, in 2011, they were generating roughly 9,500 crores of sales. And right now they are generating only 5,717 crores of sales. So their sales have been cut into half. But the interesting part is that their profits have not been cut into half. They used to make 1542 crores of profit back in 2011. Right now also they are making approximately the same amount of profit. So their overall profitability has increased. Why would that be the case? One of the key reasons was that the company brought down its debt quite a lot. Second key reason was that now the company is selectively picking projects that it wants to invest in, which is a good sign. But unfortunately, this strategy is not helping its stock price. So let me walk you through the stock price of DLF as well. So if you consider that the stock literally peaked at the boom of 2008 cycle, after 2008 crash, the stock has been considerably going down. So at its peak, it was trading at roughly 1200. And right now it is trading at roughly 323. So the stock has roughly lost 75% of its value. This is despite a major rebound that has happened post 2020 COVID period. So now comes the natural question that, okay, company is good, debt is low. Maybe they are revamping their business structure, business model. The trading price is somewhat sensible. Real estate market is coming back. One of the oldest real estate players. So should I go and invest my money? Now, of course, I'm not going to give you a recommendation, but let me speak about some of the major developments that are happening with DLF. So the first key point that you need to know about DLF's business model is that the business, unfortunately, is maturing. It might have already seen its best days when they were developing Gurgaon. Now you can clearly see that over the years, the number of projects under construction for DLF has been going down and down and down. This is by design. They are deliberately changing their business model from build and operate to build and lease. So their leasing area is going down, but they are not constructing project to sell it. Or rather, they are constructing fewer projects to do the sales. There can be multiple reasons for the same, because they were predominantly Gurgaon or NCR based. Now that sector or that area has been developed quite aggressively, and DLF might be finding it hard to move to other locations and geographies in India because the real estate market is highly localized. Yesterday, I had made a video on REITs. Please go and watch it. Very, very important video. It will help you understand more about how real estate sector operates. But I hope you get the picture that right now DLF is undergoing major prominent changes. Its business might have already peaked and they are deliberately changing their model to a lease-based model. Now to add on to that, recently there was an announcement made that DLF is trying to get into REITs-based business. Why they are trying to do it? Simply because of the fact that they control a lot of properties. They can easily lease it out. If they convert their entire unit or entity into a REITs, they can get at least 2 to 4% commission by converting their model into a REITs-based model. So it makes a lot of sense for a company like DLF to do it, and they are already underway of doing it. Now, let me finally talk about some of the development plans that DLF is trying to undertake. So first and foremost, they are trying to expand to newer markets, especially something like Goa. They are trying to build their base there. And here is a quick snippet about the same. You can pause it and read through this snippet. They are also trying to launch some affordable housing products. And on top of that, they are trying to turn their entire organization into a REITs-based organization, which is again a major, massive change in their business model. So my overall impression about the company is that company right now is in a big experimental phase. The experiment can go either way. I would wait for the company to start its own REIT-based service, look at its performance, and then make a call whether to invest in it. Again, this is not an investment advice. You should act as per your understanding. Please take my inputs as an additional input to your research. Now let's talk about third stock, which is Godrej Properties. So first and foremost aspect of Godrej Properties business is that it is a very well diversified model geographically speaking. So for example, Pune is their prominent base, but they are also in Bangalore, they are also in Mumbai, they are also in NCR, and they are getting almost equal amount of business from all these locations. So it is a highly diversified business, unlike DLF. The second key point about Godrej Properties is that it has been able to expand its market share quite aggressively. So this is a very positive sign that they probably understand the pulse of the real estate market and are able to snatch more and more share from their competitors. So for example, this snippet will tell you that they were able to snatch a lot of market share from NCR-based builders from approximately 2.2% to roughly 7.7%. Now, third key point or the major moat of Godrej Properties is that because of the Godrej name, they are able to access funding at a lower cost. Why does that happen? Because whenever a conglomerate takes debt, for example, Reliance, Adani, Tatas, they usually get debt at a much better rate compared to local players. Why? Because these are more trustable brands, so to say. Same applies to Godrej, Mahindra, etc., that they are able to get access to funding at relatively less expensive cost. Now, this becomes a major competitive advantage, especially when you are dealing in infrastructure project, because that is where you require a lot of debt. Just to give you an estimate, the total debt on Adani's is roughly 2.21 lakh crore, and this has been up by 40% in the last 1 year itself. So getting access to debt and getting access to inexpensive debt becomes a competitive advantage for conglomerate players. Let me know in the comment box if you would want me to make a video on Adani's debt. I'll be happy to do it. But back to Godrej Properties, one of the key things that they are doing right now is that they are aggressively expanding the market. So they are looking to invest roughly 7,500 crore rupee into the market in the next 12 to 18 months. And for this, they have already been able to raise a lot of money. So almost 50% of that money has already been raised. So they have been able to successfully procure capital, and now they are just simply looking to deploy that capital and generate results. So between DLF and Godrej Properties, which company would I feel is better placed to benefit from the boom in real estate? I would say Godrej Properties. And finally, let me show you the numbers as to how the company has been performing over the last few years. So you can see that the market cap of Godrej Properties is roughly 40,000 crore. It is half the size of DLF. Their debt is high because they have procured debt as of now, which they will be deploying. This becomes a double-edged sword simply because of the fact that if the money that they have raised, they are not able to generate returns out of it, it becomes a problem for them. But yes, by taking this debt, they are able to invest in good projects. Of course, it can lead to a lot of growth for the business and for the shareholders' wealth as well. So let us quickly look at how the company has been performing over the last 1 decade. So you can see that back in 2011, their sales used to be roughly 500 crores. Now it has reached all the way to 1800. It peaked in 2020, and then after that, by 2021, real estate market had really slowed down. So right now we can definitely approximate the total sales volume to be around 2000 crore, which is a fairly decent growth in the last 10 years. Same goes for profit, that they have been able to almost 3x their profit in the last 1 decade. So it shows that the company knows how to grow their wealth. Let us finally talk about the stock price also, as to how the stock price has behaved. So the company's stock price grew to approximately 2350 rupees back in October of 2021. Now it has been cut down into half almost. So I would say that there is enough margin of safety. If real estate sector starts to bounce back, it will definitely help companies like Godrej Properties. So this brings us to the final stock, and the final stock here is, you might consider it to be a realty stock, or you might consider it to be a bank or an NBFC. It is Aavas Financiers, and this is one of my favorite stocks on this list that I have discussed. And let me very quickly talk about it, because I have already spoken about Aavas Financiers on some of my other videos. First and foremost, I already hold this stock, and I will be building more positions in the stock going forward. Does it mean that I'm going to buy it tomorrow? Maybe, maybe not. I'm not disclosing that. But to cut the long story short, I feel that Aavas Financiers is a very good stock. Now, why is that? So let us first and foremost understand the business model of Aavas Financiers, and you will see that they give out a lot of different types of home loans. For example, they give out outright home loans, they give home improvement loans, they give renovation loans, they give rural housing loans, they give rural housing loans for self-employed and salaried people. So there are different categories of housing loans that they give. So who are their customer base? Let me show you a very quick spread there. So you will see that 99.99% of their customer base are retail people. They are giving direct B2C loan, not B2B loans. So this is point one. Point two is that if you take a look at their market share in the housing loan segment, it used to be roughly 0.1 in March of 2015-2016. And now it is up quite a lot to approximately 0.34%, which is a significant growth in less than a decade. So Aavas Financiers has been able to grow their business quite aggressively. Now, just to help you understand this point better, let us look at their balance sheet and financial statements also. So you can see that back in 2014, their revenues were 54 crores. Now it is almost at 25 times. Same applies to even profits, that they were sitting on a profit of 6 crores. Now their net profit is roughly 350 crores and has constantly grown. So overall, very solid financials from that perspective. Now comes point number 3, that are their loans risky? Are their loans not risky? What is the major moat of the company? So let me very quickly talk about that. Now, if you check their annual reports, what you will find is that the number of active loans have been increasing quite steadily. The asset under management has been increasing quite steadily. So as the loan books expand, the risk naturally goes down because of diversification. So this is the first key point. Now, second and more interesting point is for you to understand how retail loans are given. For example, when you and I take a home loan, how much time do you think that banks give us in case we are not able to pay our EMI? I don't know. Even if we request, I don't think we are getting an extension of more than 1 year. So the point that I'm trying to drive home is that small players like you and me, when we take home loans, we have to pay it. Big business can default. But small players like you and me, we will still have to go and pay our EMIs. And 99% of customer base of Aavas Financiers are people like you and me. On top of that, think about it this way, that if they are dealing into housing loans, and even if we default or 5% of people default, there is still some collateral in place. On top of that, majority of the loans given by Aavas Financiers are small ticket loans because they are into rural housing, they are into home improvements and bunch of other different types of loans. So to cut the long story short, what I'm trying to tell you is that the nature of loans that Aavas Financiers is giving, it is managed in such a way that the risk is hedged to a very large extent. Does it mean that 100% will the stock price rise? I don't know. I can't comment on that. But overall, it's a solid business with good fundamentals. And this is definitely reflected into two specific metrics. One is cost of borrowing, which has been coming down quite aggressively over the last few years. And this is happening because of the second matrix that I had talked about earlier, which is the growth in their asset books, which is outlined by asset under management. So net, it's a growth company. It is still into very early stages of its journey. And therefore, I feel that it is one of the best real estate sector stocks, so to say. Let me know in the comment box that which of these 4 stocks do you think are good, bad, average, and what positions you might not take in it. I would love to read your commentary. I hope you enjoyed this video and I will see you soon.